If you fancy learning how you can own real estate without even taking out a mortgage or buying a property, then keep watching. I live in the UK, and as of right now, I do not own any property. But in the near future, I plan to begin building a property portfolio and investing in real estate, but not in the traditional manner. I am not going to be focusing on saving a hefty deposit and securing a mortgage, but instead I'm just going to be pressing one button on my laptop. What I plan to do is get myself some exposure to REITs, and this stands for Real Estate Investment Trusts. Let me explain. Everyone knows that many wealthy people have themselves a property portfolio, but that can be pretty hard to relate to when you're just not in the position to purchase your own property, let alone properties to rent out to other people. However, having some exposure to the real estate and property market is not such a bad idea. In case you've not heard of a REIT before, let's just start by talking about what exactly they are. And if you are familiar with the term REIT and you know all about them already, then please feel free to skip through this video using the timestamps in the description box. A real estate investment trust, so a REIT, is a corporation, a collection of people that maintain, manage and fund real estate. And then it's this real estate that goes on to produce revenue. You can also get what is called a mortgage REIT, but 90% of all REITs are equity based, so those are the ones we're going to stick to today. REITs are bought and sold just like stocks and shares are. With stocks, you as an investor invest into a company and then you own part of that company. And you can even get paid for owning part of that company, and that is what's called a dividend. The company essentially pays you for investing in their company. And this is quite similar with REITs. You as an investor would invest into a REIT, and then as a compensation package for investing, if you will, they will pay you a portion of the income generated. So that's a portion of the rent that real estate is generating. When you invest into a REIT, the REIT would use your money along with all the other investors' money that have also decided to invest in that particular REIT, and they would use it to acquire and maintain different types of real estate. So this could be commercial real estate, residential real estate, it can be office buildings, it can be shopping centres, warehouses, it can be anything really. And then of course they charge their customers rent for having a shop in the shopping mall that they own, or having a flat in the building that they own, or renting out offices in the office building that they own, and then all that rent gets distributed back to the investors. And it's surprising just how much of the rent generated actually goes back to the investors. So keep watching and I'll let you know the exact percentage. Okay, so now we know what REITs are, we need to kind of talk about why they're good. And there are a few key reasons as to why they could be a good idea for an investor. The first reason, and perhaps the most important for many investors, is that REITs allow you to get exposure to property in a really accessible way. So like I said at the beginning of this video, this is a way that you can invest into the property market without actually buying a house. And this, of course, is really great for portfolio diversification. If you want a truly diversified portfolio, then ideally you want to have companies from all different sectors. And this is how you might decide to add property into your investment portfolio. In the UK and also in the US, I believe, there are some quite strict rules about REITs and how they're run. And one of these rules that is particularly interesting to an investor is that 90% of all the income generated must go back to the investors. And this means that you could definitely start a passive income stream through this type of investment. You could definitely build a steady dividend income stream through the steady cash flow and the capital appreciation that REITs allow. So leading on from this and talking about income still, it's a really trustworthy source of income. Of course, nothing in this world is guaranteed, as we already know. But typically, when we talk about renting to businesses, the lease on those rentals tend to be quite long. And once the business has signed that lease, they are legally obligated to pay that rent for that time period. So that provides quite a trustworthy source of income for any investors. So if you're investing in a REIT and that real estate investment trust is one that perhaps owns shopping centres or owns commercial office buildings, then their clients are obligated to pay rent to them. And if they need to break that contract for any reason, they will either have to sell that place to someone else or someone else will need to take over that rent. So from an investor's point of view, you're kind of guaranteed the income. The next reason why REITs are good is that they are somewhat inflation proof. Typically, people say that property and rental income is a really good hedge against inflation, which would of course provide investors in REITs a bit of comfort. I'm going to leave this one open to you guys. Let me know in the comments below, do you think that property is a good bet against inflation? The next reason is that REITs tend to have a good liquidity. So what do I mean by this? This is how quickly and easily you can sell out of an investment and cash the money. If you owned a house and that was your exposure to the property market and that was your only investment and you needed a lot of money quickly, then you may be left with no choice but to sell that house in order to get some cash. Now, if you live in the UK, selling a house is by no means an easy or quick process. It can take months on months on months. This means that property in its traditional sense is not really an asset that you can get rid of quickly in order to gain some cash. If you're trying to get money from a property, you need to list that property on the market and you need to sell that property, which, as I said, takes a very long time. Whereas if you have exposure to a REIT, all you really need to do is sell your exposure. So you just need to press a button on your laptop and, the cash will be in your account probably maybe the same day, but if not, within a few days. This works the same as it does with stocks. There are two reasons left that I can think of as to why REITs may be a good thing to have in your portfolio. REITs are really, really passive. Now, if you own a property that you rent out, you have some obligation to either pay a manager to look after that property, or you need to go out and see to that property whenever your tenants require. So if your tenants report that the light bulb's broken or the toilet needs fixing, you need to go and do that, or you need to pay someone and organize that to happen. And that's going to take time and money. Whereas with a REIT, you're not going to get phoned up that you need to go and fix a property that you own that may be halfway across the country. It doesn't work like that. That's all managed separately from you. You have nothing to do with it. All you do is invest some money into one of these real estate investment trusts, collect the dividend if they pay it, and that's about it really. And the last reason is that REITs are very, very tax efficient. They do not have to pay corporation tax. So if you didn't know about this, this is basically the tax that the businesses that you probably invest in have to pay. And typically that tends to sit at 19% here in the UK. And you might be wondering, well, why do I care as an investor? Why is this good? It's good because it essentially means that they keep more of their money, which then in turn means that more of the income generated is not going to taxes, but is instead going to you as an investor. And of course, if you put these REITs into an ISA, it's even more tax efficient. So now that we've gone through some of the potential benefits, let's now talk about how you would actually make money through investing in REITs. And essentially this is really simple. There are two straightforward ways. The first way is through income. So as an investor, you will get paid a dividend for owning part of the REIT, just like you would with dividend paying stocks. And then you can decide whether you want to cash that money out and spend it on whatever else you want to spend it on in your life, or whether you want to reinvest it back into the company, the REIT, or perhaps even into a different stock. The second way is through capital gains appreciation. So this is selling your shares at a profit. So now I just wanted to take the time to let you guys know a couple of good REITs that I think are good that are available here in the UK. The first one is the iShares UK Property ETF. As you can probably tell by its name, this one is an ETF. And essentially what it's doing is it's tracking the performance of UK real estate companies and real estate investment trusts. And you can view this one as a way to own lots of different REITs in just one investment. Just like you would think of an ETF as owning lots of different stocks in one fund. Let's just have a look at how this has been performing over time. So here's the chart, and if I just go on the 1 month view, we can see that it's down by 3.5% over the last month. If we increase this to 6 months, we can see that it's up by nearly 3% over the last 6 months. And now let's look at the last year. It's up by about 22%, which is really, really good. 5 years, it's up by 15.5%. And if we max it out here from the time of inception, it's down about 38%. But you can gradually see it increase in here. So I believe it's still quite a good investment. The dividend yield for this one is just over 2%, and they pay quarterly dividends. So you would get, as an investor, full payments for owning this REIT per year. And as I said, this is an ETF, so you're not just getting one particular real estate company or one particular REIT. And instead, let's just have a look here. You are getting a lot of different REITs here. So British Land is one of the biggest. You get in Tritax, which we'll talk about in a minute. You get in the Big Yellow Group. You get in Safe Store Holdings. Many different exposures, which could be something that you may want to do if you are interested in this, but you don't just want to pin all of your efforts onto one REIT. Now, the next one I want to mention, but I don't necessarily think it makes the list today, is British Land. British Land focus on offices and retail in London more than any other type of property. So I just don't think there's much growth here for this company unless they shift the way that they're doing things, which of course they might. And this is of course as well just my opinion, but with the way that the world's going, with people working from home, people ordering online, I don't really see this to be an area of big growth. I still think that British Land is a decent investment, but I just think some of the others perhaps are a little bit better. Having said that, British Land could of course shift their focus and be a great investment. The last REIT that I wanted to mention is Tritax Big Box REIT. And they essentially have big warehouses where they store and ship other companies' products. Tritax are a company that own those massive warehouses that essentially store and ship online products. And I just wanted to read something that I saw on their website which sums this up nicely. They've said, most of our investment assets and development portfolio are focused on large assets exceeding 500,000 square feet. This makes them flexible and efficient and generates economies of size, enabling cost efficiencies for our customers. They have some massive customers. They have Royal Mail, Amazon, DHL, and the list honestly just goes on. If you go onto their website, you can see all of their customers, and yeah, I don't see them going anywhere soon, especially as I said, because we're seeing more online ordering, and I don't think the world's going to change. I'm not sure everyone's going to suddenly stop using online shopping and go out to the shops. I just don't see that happening. And all whilst there is a push for online shopping, these guys will be needed. Their dividend yield sits at 2.76%, and again, they pay quarterly dividend payments out to their investors. And let's just take a look at their performance. So over the last 5 days, they have been up by 0.3%. Over the last month, down by nearly 5%. 6 months, up by nearly 13%. In the last year, they've been up by nearly 28%, which is really good. And if we just look at 5 years, wow, up by nearly 70%. And if we max the graph out here, yeah, we can see that over time, since inception, they have been up by 138%. And, you know, the graph is looking good. Steadily, they are growing. So that's a really good sign. I've only mentioned a few REITs today that I think are particularly good investments, but of course, there are many out there. So definitely do your own research, as I'm no financial advisor. In case you didn't know, I am looking to start making a dividend growth portfolio in the near future, and I will definitely be including some REITs in that. If you want to know how to buy REITs, you can essentially buy them just like you can ETFs and stocks from pretty much any platform that you already use to invest in. If you want to see an example of a dividend stock portfolio that will pay you at least twice a month, then click right here.